Don, Sotheby's recently releasing their, spring forecast and also a look back at the first quarter of this year. Some of the highlights have suggested that condominium sales seems to be dominating that top tier market.
Yeah, that's what we found. I mean, we tried to find something that really stood out, and one of the areas that really jumped out at us was the strength of the condominium market, which is probably really reflective of the fact that there is a lack of supply on the other aspects of the market. So, yeah, in pretty much most of the markets across the country, condominiums were playing a major role in that market.
With interest rates on the rise, does this factor into the top tier market?
It's actually been evolving since we actually released the top tier report. So what's happened is obviously we've had a number of rate increases, and I believe we're actually in what we call kind of a period of adjustment right now, where I think consumers are getting used to the rising interest rates. For some of them, it's a bit of a shock. But for a lot of people that were, around a little bit longer, even 5% is still a historically low interest rate. So, I think as we go through this transition period, what we found is you really have to look at the entire market fundamentals of what's happening in the Canadian marketplace. We still are a global destination. We still are a place that people want to come and live. And then we also have a lot of immigrants that are coming to Canada over the next number of years. Numbers range anywhere from 1.6 to 2 million that are coming over the next little while. Now, we recently had the proposed foreign buyer ban, which, we still don't know the details, but I think that will maybe take a few people out of the market, but probably not a lot of people. And then I think you have to look right across the country. We've got a chronic undersupply of inventory that we've had for decades. So you kind of look at where we have been in the last little while. We've had a very frothy market. And really, I think the best way to summarize, the froth is really coming out of the market. It's taking a little bit longer to sell the property. The days on market are increasing, but relative to, kind of historic trends, it's just really almost a return to a normalized market. And I think that's probably the best way to summarize what's going on. Like, we still have some sellers right now that have, expectations of the market when it was a little bit frothy. So they have to, basically get their kind of thoughts in line with the market reality. We still have a lot of, pent up buyer demand. If properties are priced right, they are selling. We just had a home, 3 million in Niagara-on-the-Lake, which is fairly expensive for Niagara-on-the-Lake, went in multiple offers. So the market right now is really probably a return to normalization. And that's probably just what people have to get used to, this new reality.
Don, in the report, you mentioned that buyer confidence has returned to major metropolitan areas, specifically that downtown and urban market. Is that downtown living back?
Yeah, I think it really comes back to the supply issue at the end of the day. I believe confidence has returned. I mean, there's still going to be the COVID effect. I still think there's going to be people, that will want to look for the bigger space, live outside the city, but a lot of people, have returned, and the market is showing that. And the fact that we don't have a lot of detached inventory, a lot of semi-detached inventory, obviously your next best option is going to be the condominiums. And that's why we're seeing that reflected in the activity in that space.
You had touched on this a little bit earlier with respect to rising interest rates, and curious to hear from your vantage point, what are the headwinds that could be facing top tier? Of course, we know the Bank of Canada trying to do its job when it comes to this overheated economy. You've mentioned supply. You've mentioned government policy. What are the biggest headwinds?
Well, I really think, there's a few things. Obviously, the supply chain is going to play a role because, obviously, if we're going to build more homes, we need to have the materials to build them, which is right now a bit of an issue. We also have a shortage of trades. We also have some, some strikes recently in the trade space. So that's going to create some disruptions. So I think, these all combined, just will make the supply issue that much harder to tackle. But I think when it really comes down to it, it has to be, the governments on all three levels have to start, removing the red tape and bureaucracy from building new homes. And we have to build homes that people want, not just, one bedroom condominiums. I mean, consumers want, detached homes. They want larger condominiums. So we have to build types that the consumers want. And I think that's really going to be important going forward. But really the big issue in terms of the headwinds right now is probably going to be supply chain and lack of trades and the bureaucracy and red tape around new developments.
The report touches on the GTA, the Greater Toronto Area, Vancouver, Calgary, Montreal. Is there one city where the data coming out of there is surprising? I saw the numbers for Montreal, and I guess it's sales over 4 million are up 140% year over year.
I guess there's two areas. Obviously Calgary, is the most affordable spot in the country right now. So, we are seeing increased activity. In the first quarter, we're continuing to see a lot of activity based on the affordability. And the same thing, Montreal was driven by an affordability perspective too. But we did see in the condominium space, in the luxury condominium, we saw a lot more activity in the million plus than we've ever seen before. So that was unusual activity. But all in all, those two markets probably, had the most unique attributes based on the affordability of those two markets.
You have mentioned some of the numbers when it comes to top tier real estate, that $1 million and up, $4 million and up. When it comes to the ultra luxury market, indulge us for a moment. What are you seeing there?
Well, the ultra top tier really aren't affected by interest rates, right? They're kind of immune to interest rates, and I really, that market segment really, when they want to move, they move. One of the things that they really look for is they are very specific in terms of the attributes and the amenities in the homes they're buying. So that market, continues to move, and there's activity there, and it's obviously. When the lower markets are all firing, it's a kind of a chain effect. You get movement in one space, then the next, and it moves up, and then people move from the luxury to the ultra luxury. But there's always that class in the ultra luxury that are, pretty much immune to interest rates. And so we're seeing, in some markets it's a little bit slower, but in some markets we're still seeing some movement.